Who really creates money? Governments or commercial banks? Have you ever wondered who actually creates money? Most people believe governments simply print it. Others think central banks create all the money in the economy. Surprisingly, both ideas are only partially true. The reality is far more fascinating, and once you understand it, you'll never look at your bank account the same way again. Imagine checking your bank account today and seeing a balance of $10,000. It feels like real money. You can spend it with a debit card, transfer it online, or pay your bills. But here's the surprising question. Where did those digital dollars actually come from? Were they printed by the government? Were they created by the central bank? Or did something else happen behind the scenes? To answer that question, we first need to understand that not all money is created in the same way. The money in your wallet, cash and coins, is known as physical money. In most countries, this money is issued by the central bank and the national mint under government authority. It's the type of money most people imagine when they think about printing money. But here's the surprising part. Cash makes up only a small percentage of the total money people use every day. In many modern economies, more than 90% of the money exists only as digital numbers inside bank accounts. You receive your salary electronically. You pay with your debit card. You transfer money using your phone. Most of the world's money never exists as paper bills. So who creates all of that digital money? The answer is commercial banks. This surprises many people because banks don't simply lend out money that other customers deposited. While customer deposits are important, modern banks also create new money whenever they issue certain types of loans. Imagine you walk into a bank and apply for a $200,000 mortgage to buy a house. Many people believe the bank looks inside its vault, takes money that someone else deposited, and hands it to you. But that's not what usually happens. Instead, once your loan is approved, the bank simply credits your account with $200,000. Those dollars didn't previously exist in your account. At that moment, new digital money has been created. Of course, the bank doesn't create wealth out of thin air. At the same time it creates a deposit in your account, it also records a loan that you must repay. On the bank's balance sheet, a new asset and a new liability appear together. This process expands the amount of money circulating in the economy. This process is called money creation through bank lending, and it is one of the most important concepts in modern economics. Does that mean banks can create unlimited money? Not at all. Commercial banks operate under strict regulations. They must maintain sufficient capital, manage risks carefully, satisfy regulatory requirements, and ensure they have enough liquidity to meet customer withdrawals. Central banks also influence lending by setting interest rates and using other monetary policy tools. Think of the financial system as a car. Commercial banks are the engine that helps move money through the economy by making loans. The central bank is the driver, controlling the speed with tools such as interest rates. And the government builds the roads by creating laws, regulations, and the legal framework that allows the financial system to operate. All three play different but essential roles. So where does the central bank fit into all of this? Central banks don't usually create money by making home loans or business loans directly to ordinary people. Instead, they create what economists often call central bank money. This includes physical cash and reserves held by commercial banks at the central bank. During periods of economic stress, central banks can also purchase government bonds and other financial assets to inject liquidity into the financial system. These actions increase the amount of central bank money and influence how much lending commercial banks can support. A famous example occurred during the global financial crisis of 2008. To prevent the financial system from collapsing, many central banks purchased massive amounts of government bonds through a policy known as Quantitative Easing, often shortened to QE. This increased liquidity, lowered borrowing costs, and helped stabilize financial markets during an extremely difficult period. A similar approach was used during the COVID-19 pandemic in 2020, when many central banks expanded their balance sheets to support economies facing severe disruptions. It's important to understand that creating central bank money does not automatically mean consumers immediately receive more money in their bank accounts. the money must still flow through the banking system, businesses, and households before it affects spending throughout the economy. This is why economists often say that commercial banks create most of the money people actually use, while central banks create the foundation that allows the financial system to function smoothly. So who really creates money? The answer is that both do, but in very different ways. Governments establish the legal system and authorize the currency. Central banks issue cash, manage monetary policy, and provide the foundation for the banking system. Commercial banks create most of the digital money used every day through responsible lending. Together, these institutions form the modern monetary system that powers nearly every economy on Earth. The next time you check your bank balance, remember this: most of the money you see was never printed as paper. It was created digitally within the banking system as loans supported economic activity across society. Understanding that simple fact changes the way we think about money forever. If you enjoyed this video, please like, share, and subscribe to Money Decoded for more simple insights into money, banking, investing, and the global economy. Don't forget to turn on notifications so you never miss a new video. Thanks for watching.